Have you ever found yourself pondering over when to make the leap from an LLC to an S-corporation? Well, it's crucial to understand the difference between these two business entities. They play a significant role in safeguarding your personal assets and fostering your business growth. Whether you're just starting out or looking to scale, your choice of business structure can have far-reaching implications. And that's why knowing when to switch from an LLC to an S-corporation can be a game-changer for your business. To fully grasp when to make the switch, we first need to understand what an LLC is. An LLC, or limited liability company, is a type of business entity that combines the best of both worlds: the operational flexibility of a partnership or sole proprietorship, and the liability protection of a corporation. Its name itself reveals its main advantage: limited liability. This means that the owners, also called members, are not personally responsible for the company's debts and liabilities. So, if the company runs into financial trouble, personal assets like your home, car, or personal bank accounts are generally shielded from creditors. Now let's talk about flexibility. An LLC is incredibly adaptable in terms of management. There's no requirement for an LLC to have a board of directors or annual meetings. The members can manage the company themselves, or they can appoint managers to do so. This gives the members the freedom to run their business in a way that best suits their needs. But like all things in life, there are potential downsides to an LLC. One of the most significant is self-employment taxes. Members of an LLC are considered self-employed and must pay the self-employment tax contributions towards Medicare and Social Security. The entire net income of the LLC is subject to this tax, which can be a substantial financial burden. However, it's important to remember that the LLC is a pass-through entity. This means that the profits or losses of the business pass through to the owners who report this information on their personal income tax returns. The LLC itself does not pay federal income taxes unless it chooses to be treated as a corporation for tax purposes. In essence, an LLC offers a blend of protection, flexibility, and simplicity. It can be the perfect fit for many business owners, but the potential tax implications may lead some to consider other options. Now that we've delved into LLCs, let's turn our attention to S-corporations. Unraveling the mystery of S-corporations, let's dive right in. An S-corporation, or S-Corp for short, is a type of business entity that offers a unique blend of corporate structure and partnership benefits. It's like a hybrid, combing the best of both worlds. So, what's so special about S-corporations? Well, one of the key highlights is the avoidance of double taxation. Unlike traditional corporations known as C corporations that get taxed twice, S-corporations have a different story. The profits and losses of an S-corporation pass through to the shareholders and get reported on their individual tax returns. This way, the business itself isn't taxed, and this pass-through taxation is a significant advantage for many business owners. But it's not all sunshine and rainbows. There are certain restrictions and requirements that come with the territory. For instance, an S-corporation can have no more than 100 shareholders, and all of them must be U.S. citizens or residents. Plus, there's only one class of stock available, limiting the ability to attract different types of investors. Additionally, S-corporations face stricter operational processes. They must adopt bylaws, issue stock, hold regular meetings, and keep corporate minutes. While these requirements help maintain transparency and accountability, they can be a bit of a hassle, especially for smaller businesses that may not have the resources to effectively manage these processes. It's also important to note that S-corporations must pay reasonable compensation to shareholder employees before any dividends are distributed. This means that if you're a shareholder and also an employee, you must be paid a fair wage for your services. This can impact the profits that are distributed to shareholders and could also increase the amount of employment taxes that need to be paid. So, there you have it. The S-corporation is a unique creature in the business world. It offers significant tax advantages, but also comes with its own set of rules and requirements. With a firm grasp of LLCs and S-corporations, we can now explore when to consider making the switch. The million-dollar question: when is the right time to switch from an LLC to an S-corporation? Now that we've delved into the world of LLCs and S-corporations, let's get to the heart of the matter. When exactly should you consider making the switch? Well, there's no one-size-fits-all answer, but there are key indicators that it might be time to change lanes. Let's explore these indicators together. Firstly, when your business starts making a substantial profit, it might be a good time to consider a switch. The word substantial is subjective, of course, but a good rule of thumb is when your business is netting more than $40,000 annually after business expenses. Why $40,000, you ask? Well, this is typically the point where the self-employment taxes you're paying as an LLC start to outweigh the tax benefits. Remember, as an LLC, you're paying self-employment taxes on the entire net income of the business. However, in an S-corporation, only the salary paid to the shareholder employee is subject to employment tax. The remaining income is paid to the owner as a distribution, which is taxed at a lower rate. Now let's talk about the elephant in the room, the complexity and cost of running an S-corporation. While the tax benefits may seem attractive, it's crucial to weigh them against the added responsibilities and costs that come with running an S-corporation. S-corporations require setup and ongoing fees, additional tax returns, and payroll management. These added complexities might not be worth the tax savings for some businesses. It's also worth mentioning that if your LLC is growing rapidly and you're planning to bring on investors or issue stock, switching to an S-corporation might be a good move. S-corporations have a more formal structure that can be attractive to investors, and their stock options can provide an incentive to employees. Ultimately, the decision to switch from an LLC to an S-corporation is a balancing act. You'll need to weigh the potential tax savings against the increased complexity and cost, and consider the future growth plans for your business. Don't forget to seek professional advice. A seasoned tax professional or business advisor can provide valuable insight into your unique situation and help you make the best decision for your business. Remember, timing is everything when it comes to switching from an LLC to an S-corporation. You've decided to switch, but how does one go about it? Let's demystify the process. The first step in transitioning from an LLC to an S-corporation is to ensure that your LLC meets the qualifications for S-corporation status. These include having less than 100 shareholders, issuing only one class of stock, and having only individuals, estates, or certain trusts as shareholders. After confirming eligibility, the next step is to file IRS Form 2553, also known as the election, by a small business corporation. This form is used to apply for S-corporation status and should be filed within 2 months and 15 days of the beginning of the tax year the election is to take effect. In addition to the federal form, you'll also need to file any required state forms. The specifics vary by state, so it's critical to look up and follow the regulations where your business is based. Upon approval by the IRS, the LLC will be treated as an S-corporation for tax purposes. This means that the business will now be taxed at the shareholder level, instead of at the corporate level, potentially leading to significant tax savings. It's important to note that while the LLC will be treated as an S-corporation for tax purposes, it will continue to be treated as an LLC for the purposes of state law. This means that the business will maintain its existing liability protections. Lastly, you'll need to adjust your operating agreement and other internal documents to reflect the new tax status. This might involve changing the way profits and losses are allocated among members, as well as voting rights and other governance issues. It's advisable to seek professional help during this process. A tax advisor or attorney can guide you through the nuances and ensure you're making the best decisions for your business. Switching from an LLC to an S-corporation might seem daunting, but with these steps, it becomes a straightforward process. We've journeyed through the world of LLCs and S-corporations, but let's not forget the key takeaways. We dipped our toes into the pool of business entities, understanding the fundamental workings of LLCs and S-corporations. We discovered that LLCs offer flexibility with fewer regulations, but S-corporations provide potential tax benefits and attract investors with their structure. Then, we navigated the terrain of transition, pinpointing the signs that might suggest it's time to switch. Remember, skyrocketing profits, planning to bring on investors, or the desire to save on self-employment taxes are clear indicators. We also unraveled the process of making that switch, from filing the IRS Form 2553 to notifying your state's Secretary of State. It's not a leap of faith, but a calculated decision backed by strategic steps. Remember, the right business entity can make all the difference. Choose wisely, and your business will thank you.